Hi, I'm Simon Cooper, and alongside me is a colleague, Rian Esterhuizen. We both work for VOX, which is a precious metals, a high growth precious metals royalty company. We've got a portfolio now of over 50 royalties and streams right across the globe. And I guess we were established back in 2014. And since then really built quite a unique IP in terms of an existing royalty database. We've put together a technically focused team, which includes myself, Rian, and Spencer, another colleague who all work on the deal sourcing front. And I guess the culmination of that has been that we've been one of the faster growing royalty companies in the space over the last couple of years. I am our VP of Corporate Development. My background is in mining, engineering, and geology. I've sort of worked in everything from exploration, from greenfields exploration through to at a number of sort of producing roles at operating mine sites globally, boots on the ground experience in Australia, in Central Asia and Africa, and joined VOX about 5 years ago, initially in a technical DD focused role, and have since expanded that into this sort of corporate development and getting in front of new opportunities. Rian is our EVP of Australia. Obviously, we work pretty closely on the deal sourcing and origination front. He's an exploration and mining geologist by trade, worked with Randgold, Rio Tinto, BHP, very significant sort of multi-commodity and country exposure, and also a lot of royalty exposure, starting initially at BHP, then went on to found a company called Mineral Royalties Online, which was effectively built up that intellectual property in that database. We acquired MRO and have since obviously been working together to build VOX.
Thank you very much, Simon. Rian, how are you? In fact, where are you?
Yeah,
both?
Good yourself, Matt. Matt. So I'm based in Perth. I've been in Australia for 10 years now. As Simon said, I used to work for BHP and Rio. A lot of that was across Africa, including Southern Africa. Spent a lot of time in West Africa, Guinea, Mali, Mauritania. Fair bit of work in the DRC as well. But I've been in Australia for 10 years now. Left BHP 7 odd years ago, and then worked with Spencer on building MRO, and we've been on board with VOX just sort of 6 months prior to the listing in May last year.
Brilliant. Okay, well, I appreciate you guys coming on, because we've spoken with Kyle and Spencer on a couple of occasions. Really interested in how you guys have gone about putting together VOX Royalty. It was sort of one of the standout royalty companies that we interviewed this year. So I'm sort of very keen to see what's happening also in another hot jurisdiction outside of North America, being Australia, and what's going on there. So why don't we take care of a little bit of housekeeping, which is the stuff you're going to want to tell me about before I ask you the questions that you probably aren't prepared for. So you've done 3 deals recently in Australia. I mean, Rian, what's happening?
Yes, Matt. So we announced since the capital raising in March, we've announced 3 deals. The first one, Janet Ivy. It's a production stage asset operated by Norton Goldfields, which is the Australian subsidiary of the global Zijin Mining Group. At the moment, they are sort of mining and trucking ore to their Paddington mill. The big catalyst for us, however, is that they last year approved a 15 million tonne per annum heap leach project at Bunduli, which is immediately adjacent to the Janet Ivy mine. So that should be in first production by March of next year, and we expect we'll see a significant ramp up in production from Janet Ivy. The second royalty we acquired, pre-production, called Otto Bore. It's a 2.5% NSR. It's located 5 kilometers to the east of Northern Star's Thunderbox operations. It's a 170,000 ounce resource. Our royalty covers the southern half of that, and it has been flagged previously as an asset that will be mined as a satellite pit to the Thunderbox operation. So that's pre-production. We expect that could advance rapidly over the next couple of months. The third royalty, again, Western Australia. We acquired the Bullabulling royalty. It's a $10 an ounce royalty. It's a pretty large deposit that a total of 3 million ounces. Our royalty covers approximately 775,000 ounces of that. Also interesting for us is that Norton bought back another royalty over that deposit in late 2019, paid 3.1 million for it. And for us, that's good news, as it signals intent on Norton's part to advance studies and ultimately develop that project. So those are the assets in Western Australia we've acquired. I'll just briefly mention the latest acquisition was our first royalty in Nevada. We just acquired a 0.633% NSI with the South Railroad project, which is operated by Gold Standard Ventures. Very excited about sort of getting our foot on our first royalty in Nevada. So also looking forward to growing that portfolio over time. But at this stage, as you say, we heavily weighted still to Australia, 30 plus royalties, mostly Western Australia. We've got a few assets in Queensland, South Australia, etc. But at this stage, the focus is heavily still on Western Australia.
But to what end? I mean, how do you profile or prioritize the types of royalties that you want to go after? Because funds are limited, so you've got to go for the good stuff, the low hanging fruit. Sorry, you've got to go for the good stuff first. One would have thought, because we talked to Carl and Spencer, and it's like, it's about cash and cash returns, and we want 1 times multiple. We don't want to waste our money on stuff which isn't going to deliver that sort of profile quickly to us. Because if you look at the marketplace, your share price has been up and down. It's been on a roller coaster ride here, because it's affected by gold price, it's affected by announcements from the Fed. It's very reactionary to what market sentiment is. So you've got to be really on it. So talk us through what you tend to look for or want to look for for Western Australian deals.
Yes. So I think, for us, it's continuing to do more of the same. So really predominantly still focusing on sort of assets which are sort of 12 to 24 months out from that first production. But again, it's looking to ultimately replicate some of the transactions that we've done in the past. We've been really successful with some of the, catalysts that have come from those projects at breakneck speed, sort of compared to what we've even expected. So as you alluded to, I think you're absolutely right. A lot of the Australian counterparties that we have very healthy balance sheets at the moment. They're very well capitalized, and they're using that capital to our advantage and to VOX's shareholders' advantage. So even just touching on that, and I guess what, it kind of feeds into what we're looking for. We've been blessed with a huge amount of operator updates from our gold or from our precious metals, predominantly our precious metals focused assets out of Australia. We've got 120,000 meters of drilling just across some of the key gold assets. We've had 4 different sets of high grade, sort of, or bonanza grade, effectively in some cases, drill results out of those precious metals assets. So we've had Broaden, which is the largest undeveloped primary silver project in Australia, which has come back with sort of up to 10 meters at sort of over 500 grams per ton, and in some cases smaller intercepts over 1,300 grams a ton. We've had 2 advanced stage royalties, which we acquired fairly recently. So one in February of this year, and this kind of feeds into what do we look for. This is what we look for on that asset. They've had some bonanza grade, so sort of 1 ounce per ton over 3 meters, and another asset called the Crux project, which is again some sort of 19 gram per ton. 3 meters at 19 grams per ton. They're advanced exploration assets. They're within trucking distance to an existing mill. So, acquiring them at obviously a deep value, and we've seen this catalyst play out. But probably most interestingly, we've had what looks to be a new discovery on an asset that we acquired last year for 100,000 Australian dollars. So at this stage, it's still early days, but it's over Genesis Minerals, what we call the Crux Melita project. They've flagged this discovery as an area called Puzzle North, and it's adding to their existing 1.6 million ounce deposit. And it's developing into, it's early days, but it's developing into a pretty significant shallow gold mineralized zone, which has the makings of an open pit. So in terms of what we look for those royalties that, again, 18 to 24 months out, but also where we can perhaps see, and others maybe aren't, see those sort of fundamental catalysts that are going to drive value.
I'm trying to get to the heart of your strategy and why it's different, because when we've interviewed royalty companies, there's some out there who will just do a deal for the sake of doing a deal, right? It doesn't matter what the cost. It's kind of just get noticed, get something, in the bank, and literally just let's write. We got some deals going here, and they'll generate cash at some point, and the return profile is almost secondary, right? And then there are kind of groups who don't seem quite clear what it is that they're after. That again, they'll take anything. They don't want to overpay, but they just want to do a deal. You guys seem very honed in on North America, Australia. I get that. Precious metals primarily. I get that. But how are you using your database, the thing that Spencer and Rian have put together to increase your chance of success? Because there's going to be, you could probably prioritize that database in terms of, meeting your profile, not meeting your profile, getting a deal done versus getting the right deal done. I mean, how do you go about using it on a week by week basis, or 5 month basis, however you work?
Yeah, look, I think it's a big part of what differentiates us as VOX, is we have that database that's been developed over the 10 years. That's got, when we acquired it was sort of north of 7,000. It's now north of 8,000 royalties. But I guess, how do we leverage that? I guess what we do is we look to high grade it. You're absolutely right. We sort of look at, we'll run screens consistently to get in front of, different opportunities that kind of fit what we're looking for in terms of acquiring royalties. And what it does is it helps us, as Rian alluded to, get in front of unconventional sellers. It gives us the ability to transact bilaterally more often. It's not to say that, every time we get in front of opportunity, we're the first one there, but for a lot of them, we are. And I guess as a result of that, it's been one of the reasons that, we are the second largest holder of royalties in Australia, sort of after Franco, because we have, tapped into and targeted the database for there. So we've kind of seen the opportunity to say, hey, Australia is a great mining jurisdiction, obviously a little bit biased, but, it's hard to argue with. And as a result of that, we said, let's go and, wrap up those opportunities or acquire those opportunities while we still can.
We have a very robust and structured due diligence process as well. So, through the database, we're able to identify, many opportunities. So, we follow a very specific due diligence process in trying to identify which of those opportunities have a clear pathway to moving up the exploration curve to the development stage. So that's a big part of it as well for us is, obviously high grading the database, but then also having the ability to quickly screen through that process. And some of our team members have sort of come from the big majors, and we try and sort of apply best practice due diligence that you would typically find at those companies. We do things like resource range analysis, which, at the junior end, you don't often see that. And sort of going through that process sort of helps us to determine min and max cases when we look at opportunities, even at the exploration stage. So we look at an asset, we can try and, it's not an exact science geology, as you well know, but at least gives us a handle on the potential upside of an asset when we look at it, and whether there are any fatal flaws when the operator claims there could be 1 million ounces. So we actually have a good look at that and see if that's real. And that could include looking at things like the strike extent of the host geology and the width of the geology. And you could do a simple volume calculation, and based on historical drilling, work out that 1 million ounces is simply not achievable, based on the geology on the tenure. So we run through those sort of exercises to quickly filter out the lower quality opportunities, and then high grade things that we pursue. The 3 WA recent acquisitions are all projects that we could see in production in the next 12 to 24 months.
So why aren't you taking what the company says at face value? I mean, we retail investors have to do that.
Why don't we? Well, we have the responsibility of deploying shareholder capital. So, and if you at the exploration end of the market, there's obviously, a lot of explorers that are not in the business of actually finding a deposit. It's just a case of churning things over. Something like resource range analysis would actually expose some junior companies potentially. If you ran through the exercise, you could quickly see that there's simply not enough upside there. But a portion of the junior market, obviously not all of them, but certain portion, would absolutely not do that sort of exercise because it could kill projects quite quickly.
So explain that, because that's fascinating to me, because we've got a lot of family offices and retail, high net worth, etc. on here who, they take at face value what the company says because it's all regulated. It's fine. But the reality is somewhat different. We say there's about 70% of the companies that we talk to have got no chance of getting into production, which is what you need. There's no point in having an NSR or royalty, whatever, unless they get into production. So you've got higher standards that you've got to ensure. So what are these easy methods? I mean, how could we employ your sort of diligence process? Just as you say, you keep saying the word simple. It's quite easy. Let us in on the secret.
Matt, I mean, it's not overly complex, the exercise itself. It just takes a lot of work, but, the majors do this routinely. I mean, a BHP would do this over a project. You simply look at the resource, you take the available information and you build, and you try and work out what the limitations are to the deposit size. And we can sort of take those tonnages, an optimal case or a max case, and then we feed that through a sort of risk tree while thinking through the probabilities that things will move from the one stage to the next. And that sort of ultimately feeds through to us getting to a indicative NPV. I mean, obviously, there's still a lot of assumptions in there, but going through that process, you can absolutely identify fatal flaws. And you're correct. I mean, things are regulated. You can't just make statements on stock exchange news releases, but I mean, you can call things exploration targets and have aspirational goals to get to 1 million ounces, those sort of statements. And those are the things we can absolutely test for through doing just simple, robust geology.
There's so I said I used the number 70%, and I've had lots of CEOs throw that at me. It's something that's higher, but what's the sort of success rate, a basic success rate of how many projects do you need to look at to be able to say here's one deal?
There's two ends of the spectrum, right? I think there's the end of the spectrum with respect to does it pass the technical DD hurdle, and the other end of the spectrum is do we have a motivated seller? So Rian can maybe touch on the number that passed the technical DD hurdle. And certainly there's a lot that we pass on, and we pass on them early and relatively quickly, right? Again, that's the beauty of having 8,000 royalties plus in front of us, is that we can filter through assets that we either have some familiarity with, or through looking at it for an hour or two, we're like, look, this is something that we don't ultimately see progressing to where we need it to progress to. So there are a lot that we pass on. And then on the end of the spectrum, with respect to, is there a deal to be done at a price that makes sense for us? There's I don't know, it's maybe sort of 20 prospects and one of those will get to like an LOI stage. It's a lot, again, that we churn through on that side of the equation, trying to find that deal that makes sense, that's accretive to us, because it obviously is a more competitive space.
Yeah, okay. And sorry to kind of hone down in on that, but it's just quite an important piece of the mix for us. So if you're looking as an investor, you're trying to find companies that are going to succeed. And we keep coming across, if I believed everything that I hear when we're talking to CEOs, I'd be a very poor man, I suspect. But you guys, it's a critical part of your business on the fundamental side because you need to get into production. And also as an investor, we can play the momentum play too. So, there's lots of ways that the investors can come at it. The bit there that's kind of interesting to me, Simon, is when you find something that's right, you've got to approach a company. They're not always going to want to take your cash. In fact, we've had lots of companies on here talking about buying their royalties back. That's the mood at the moment because, cash is easy, it seems. So how do you get people across the line? What type of company is more likely to want to do a deal with you?
Oh, so I guess the important thing to note is that, we focus obviously on third-party existing royalties. And so the counterparties or the sellers that we're purchasing these royalties from, they're not always necessarily other mining companies. It might be family offices, as Rian alluded to. We bought from a telco, we bought from a garage, we bought from a hearing aid company, and we consistently get in front of, prospectors. We get in front of family offices all around the world. We get in front of individuals who, in some way, shape, or other, have sort of got these royalties in their back pocket. So there's that end of the spectrum in terms of, I guess, not targeting unconventional sellers, but just by way of sort of the opportunities we get in front of. We do see ourselves in front of a lot of unconventional sellers. And the other end of the spectrum is, again, we're purchasing not from the project operator. So we're not originating, we're not providing project financing. We're purchasing from, the other mining company, if it is a mining company that holds it. And, each of those companies have their own unique circumstances and their own unique need to sort of liquidate and perhaps sort of bring in cash.
Matt, as an example, the bulling royalty, for instance, we acquired from a private individual. So no competitive sale process. Luckily for us, there was no ROFA attached to that royalty as well. We suspect Norton probably would have triggered the ROFA if they had the opportunity. So as Simon says, that's also a key component for us, is trying to identify those sort of royalty holders.
Right. And this was wanted to ask about earlier with regards to the database bit, because there's going to be, and how you prioritize it, because there's going to be some unsophisticated royalty holders who may have either didn't know they had it, forgotten they had it, didn't understand the value of what it was, et cetera, or hadn't really been tracking it for whatever reason. Is that part of the low-hanging fruit for you? Because it's also going to meet your other criteria. So, I'm sure there's lots of variables, but do you go for them?
It is. I mean, and you're absolutely right. We've come across scenarios where we've approached a royalty holder and they don't know they hold the royalty. And in certain circumstances, we've then also sort of gone on to actually help them find a copy of the royalty deed. So absolutely, that's part of the equation. I guess the differentiator for us is trying to get in front of opportunities that others aren't getting in front of. And I think when you can do that, you naturally lend yourself to having sort of a more bilateral conversation. And sort of, I know we're focused on Australia, but a big part of some of the other business development initiatives are we work with deal sourcing agents in parts of the world that, we're not all that familiar with, and other royalty companies are not all that familiar with. And again, it kind of goes to that mantra of getting in front of opportunities that others aren't actively being shopped, or it's not an active royalty market. So we work with guys in Latin America and parts of West and Sub-Saharan Africa. And again, we obviously have some networks there, but not as strong as the networks that we have, say in Australia or North America. So it's, it brings forward those opportunities out of the woodwork.
And are there certain times of the cycle in terms of, with obviously gold and silver doing their thing at the moment? Is it easier to do business when it just kind of comes off? Because it's been a little bit frothy. We've seen a lot of companies are probably well priced. Let's put it like that. So that in terms of people's perception of what's going on in the marketplace, it tends to make things more expensive, even with third-party royalty holders. Do you sort of poke your head above the parapet and when it is a little bit noisy out there, or do you tend to sit back and wait till things fall away again?
it swings and roundabouts. I think certainly in a bear market, there's a much greater need for cash if we're buying from a mining company. And so, a lot of companies are open to sort of transacting and liquidating royalties and realizing some of that value. But certainly in a bull market as well, we've got scenarios where we're looking at royalties that we're going to acquire from mining companies who are developing their own projects. So they've sat on these royalties for a long time now, and now all of a sudden they've got a capex bill on the table to move their own project forward. And so it doesn't really make sense for them to sort of sit on that third-party royalty that they've had. So, look, I think we've been able to transact sort of in both scenarios. I'd say it's probably slightly busier in a bear market just because, everybody's looking for cash, everybody's looking to liquidate and bring forward or realize that royalty revenue earlier through selling it. But again, in both markets, there's opportunities.
Yeah, Matt, I think in some instances where we acquire royalties from private individuals, they have totally different motivations in terms of keeping or potentially selling those assets. We bought assets from people who have bought properties and things and need to settle, so they're not that fixated on exactly what the gold market is doing at this stage. They just need a liquidity event and a sort of fair transaction. So we come across a lot of those sort of opportunities as well.
Well, that's what's good. I'm trying to intrigued because the whole process is fascinating to me because there's there's no cycle per se. If you look at your database, for instance, you've been at this, 2014, you said, right? And you've been at it longer than that with the database component RIAN, right? So It's not a case of, there's an optimum time to kind of get out and start, thrashing the market and selling and asking questions. It's different people have different reasons to sell at different times. So it's a fairly flat process in that sense. You don't need more cash at certain times of the cycle. It's just a case of you've got to keep knocking on the doors, and one day someone's going to turn around and say, "Yeah, okay, now I'm ready." Is that pretty much it?
Yeah, yes, Matt. I think that's a fair assumption. We never sit back and sort of say, at peak commodity prices, it's not a good time to be doing royalty deals. There are always opportunities, regardless of where commodity prices are. Because there's such a diverse range of royalty owners, from the majors down to individual owners, trusts, private companies. So I think across that spectrum, there's always opportunity for us.
So you did a deal recently with Electric Royalties, and I think it was two royalties we're talking about here. Why would a royalty company offload royalties? If someone's not getting a good deal, surely.
Look, I think there's a way to have a win-win transaction. But I think, the nuts and bolts of it, I guess the first part from our side is that, VOX is monetizing two non-core graphite royalties in Graphmata and Yalbra. And I guess, the reason that we did that is we looked at the portfolio and we said, we're precious metals focused. We've got, 70 to 80% of that weighting in precious metals, and we're not really getting a huge amount of value or, for these graphite assets. You then look at Electric. They are clearly, battery metals or focused on the suite of battery metals. And it seemed like a logical home for those royalties. And it also seemed like frankly, a logical place where both of us could, I guess, realize or maximize the value of the two royalties. So there's that end of the spectrum. And then the second end of the spectrum is, I guess, a longer term partnership where, again, we've sort of touched on a lot, but we are blessed to have this database. We come across battery and base metals opportunities all the time, given we're precious focused. There's now the opportunity to work with the Electric and potentially other royalty companies to, I guess, unlock some of that latent value that's sort of in the database.
So have you got any other non-precious metal royalties in the portfolio at the moment that you're going to be offloading?
We've got, so again, I guess how we look at the world is we've got that 70 to 80% weighting in precious. We're opportunistic outside of that. So we've got base, battery, bulk, specialty metals in that sort of other 20% range. In terms of whether we're looking to offload them, the short answer is we don't have anything at the pointy end that we're going to be transacting on. But if it's accretive, if it makes sense, if we can kind of structure something like this where, it makes sense, we will look at it. I will say, We're not going to do that for any core assets. We're not going to do that for a cornerstone gold asset. Obviously, that wouldn't make sense. But to the extent that it's kind of a win-win transaction, we'll definitely look at it.
And then I think what you alluded to a second ago was the fact that with the database, you could identify other non-precious metal royalties, which third-party royalties, which could be picked up. Are you saying you would do that, pick them up, and then flip them, or you would identify them and work with another royalty company and do a transaction and monetize it somehow?
Yeah, look, I think it would be identify them and work with another royalty company and perhaps monetize them somehow. Again, nothing that we are actively working on that front, but this is kind of perhaps opened up that avenue and opened our eyes to how we could potentially sort of work with others.
It's because I guess it's just time in your case. You own the database, so it's just time allocated and whether it makes sense. I mean, in the battery metals space, doing what it's doing at the moment across the board, it seems very, very, very heated. Are you spending much time doing that?
No, look, I guess the big upside for us and shareholders is acquiring royalties ourselves and sort of, realizing a re-rate off the back of that. So we're not, we're certainly not an investment banking firm that's looking to act on sort of the sell side. Again, it's really opportunistic. And as you said, it's making sure, we're not focusing a huge amount of time and resources on that side of things. But if there's an opportunity that pops up and it makes sense and it's something that we can sort of get over the line relatively quickly, as this electric deal was, then we'll go for it.
We sometimes also acquire sort of these additional assets as part of portfolios. I mean, you look at the Yalbra royalty, which we acquired, that was a gold deal essentially, a couple of gold exploration royalties. And in that package, there was the graphite royalty. So that's something that we just picked up, through that process. It's not something we deliberately pursued.
Got it.
So yeah, hence something that could go into the divestment bucket.
Right. Okay. Strategically, though, so Sam, one for you, and Rian, if you want to chip in, please do. Very heavily weighted towards Western Australia. Great, and I think that's the market's been really strong, and that's great. But North American investors, the biggest market in the world, they want to see North American deals. You've just done one in Nevada. Can we expect to see more?
Yeah, absolutely. We have a pipeline of between sort of 250 and 300 royalties that we've pulled from the database that we run top to bottom from weekly in terms of a business, our BD call. So look, and there are plenty of those that sit in Canada, that sit in the US, and that also sit sort of more recently, again, given that deal sourcing, a couple of deal sourcing guys we work with in Latin America that sit in that part of the world. So look, yeah, there are some that are much more advanced than others that are sort of at the pointy end with respect to moving towards LOIs and things of that nature. I will say this, for the most part, not always, but for the most part, that the North American market is slightly more competitive just because you have 20 plus other royalty companies pouring over those jurisdictions. But that said, there are opportunities that we are actively working on that are not broadly shopped, or where we do still see value and feel comfortable transacting within the North American market.
Rian, anything to add?
Yep. I think, as Simon said, on specifically that Nevada royalty, we acquired the royalty from the actual individuals that live on the ranch where the project is. So that is our focus. Where possible, we will avoid any sale process. We're doing a lot of legwork, through the database and our networks to identify under the radar opportunities, to avoid or competitive processes and the like.
So it's a very careful, meticulous process you've got to go through, and you're kind of purists in that way. Third-party royalties is real simple to understand. Are you tempted to change the strategy somewhat? Because, your market cap's been, sub 100 million for some time now. You are doing deals, but you're not getting noticed. Ely just got bought. Was that a conversation that you were tempted to have or did have?
Look, the Ely deal is interesting. It's probably not a huge surprise to us. I think there's been a lot of talk in the industry about consolidation. But look, I guess how we view M&A is, one, we're not actively for sale. And two, we haven't actively looked at, we're not sort of actively in conversations around mergers or anything of that nature. That said, if it's, again, as management, we're aligned with this thing. We own sort of collectively 15% of it. So we'd look at it through the eyes of shareholders. If it makes sense, if it's accretive, if it kind of ticks the boxes of why you should do M&A, there's synergy, or, you could expect a re-rate as a result of being a much larger company, again, we'd consider it. But it's not something that we're actively working on. Again, and the reason predominantly for that is that we see a really good runway of opportunities that we're actively working on, and we can continue to source from the database where we can go and acquire deals that are value accretive, that make sense, that continue to build out that portfolio and, I guess, propagate us from, the junior space to perhaps the mid-tier royalty space, and really sort of focus on that at that end of the equation as opposed to M&A. But again, not opposed to it. It's just that, it's got to make sense, obviously.
Do you agree, Rian?
Yes, absolutely, Matt. And, we definitely, our sort of revenues are accelerating significantly at this stage. I mean, we've given guidance sort of for this year around the 1.75 to 2.5 range. We expect that to ramp up substantially over the next 24 months. Analysts have us going to 8 million. We have 5 producing assets now. We expect we'll add potentially 3 to 5 more in the next 6 to 12 months. With additional cash flow coming in. I mean, we should also receive first cash flow from Janet Ivy next month. So we've essentially owned that asset since the 1st of April. So we have all these additional catalysts, and we'll remain focused on sort of the fundamental aspects of the royalty business, and keep the faith that, if we stick with that, we keep on growing cash flow, a number of producing assets that, that ultimately will see us grow substantially.
So you used the word accretive earlier. What's your definition of that? What does that mean for VOX Royalty?
I think we're trading at sort of around 0.8 or 0.9 times NAV, which we're not hugely happy about, when I think a lot of the space trades at sort of between 1.5 and 2 times NAV. So, I think first and foremost, we look at things on a net asset value basis. And frankly, we need to make sure that we're beating that the multiple that we're currently trading at for it to be accretive. There's obviously a whole slew of other metrics to look at with respect to sort of cash flow and revenue and the multiples off the back of that. I think they become a little bit more dangerous because some of the acquisitions that are out there that are done perhaps on a cash flow or a revenue basis can look expensive. So we tend to focus first on net asset value, and again, just making sure that we're sort of acquiring at less than what our net asset value is. And as Rian alluded to, we are certainly hoping and expecting that there's a pretty serious re-rate on where we are at the moment, just off the fundamentals. I mean, cash flow alone, we've got, analysts have us sort of doubling into next year. The number of producing royalties that we have looks very similar. So, in our eyes, we're expecting certainly that we're trading well north of where we are.
So sorry, just remind me, so it's doubling the number of royalties. Is it doubling the cash, the dollar amount? Yeah,
so at the moment, we've got, sort of as we listed, we've got 1 producing royalty. We have 5 at the moment. We're expecting that to be 8 by the end of this year. In terms of the cash flow, and I guess the guidance on that, the guidance we put out this year is between 1.7 and 2.5. Analysts next year have us going to 6 and then 8 the year after. So that really comes from, I guess, obviously assets coming online, a whole slew of assets coming online. We've got 30 royalties at the moment that have some level of study or engineering works on them. About 10 of those we can point to having as real near-term catalysts for real cash flow. So there's even room, I guess, to surprise to the upside from those numbers.
And we have 5 assets, Matt, I'll just mention. I mean, there's sort of 5 assets in the wings now that could become revenue producing quite quickly. I mean, there's the Otto Bowl, which I mentioned, Bulong again in Western Australia, that's moving ahead very quickly. Black Cat Syndicate. We've got the Mount Ida royalty that's in private hands now, so not a lot of disclosure, but we are in touch with the new owners. There's the Brits royalty, the Vanadium royalty in South Africa. That's right next door to the Vametco integrated operation. So, and even the existing pit that they're mining from sort of is down to 60 odd meters. Our royalty is an extension of that, outcropping at surface. So it's just a matter of time that bridge royalty will come into production. Once it does, I mean, that's a 20 plus year life of mine off Brits. And then we also have a few assets in Canada that we could also see revenues from in the near term.